asking what should they do to prepare for when they're going to buy a house or prepare before they fill out their loan application. Here is a quick rundown of things that you should have solidified before you apply for a mortgage to increase your chance of approval. Number one, a good credit score. There is a minimum credit score required with each different loan program. Just kind of depending on which loan program fits your needs best, there is a different credit score requirement for each different program. The lowest we are able to go on any of our loan programs is a 580 credit score. This is on an FHA loan. The lower credit score that you do have though, the harder the loan approval will be. You might have different things in your credit that would still disqualify you for that loan based on your credit score, but that's basically the lowest we can go. Ideally, you would have a credit score over 700. With a higher credit score, you're also going to have an easier loan process, and you'll also see a little bit lower of an interest rate as well. Credit scores do also affect interest rates, so that's another great reason to work on your credit score before you apply for a mortgage. Number two, stable employment and income. As part of the loan application process, we do get your past 2 years of employment history. Unstable employment history could pose some problems during the loan process. So it's super important that you have your full 2 years history of employment. This can include schooling though. If you were in college and you just recently graduated, schooling can be a part of your employment history. A good thing to mention too is to avoid changing jobs frequently, avoiding changing jobs so close to when you're going to apply for a home loan. A common myth is that you have to be on a job for a certain amount of time. With some loan programs, that is not a problem at all. There are some options as well for using future employment to qualify for a loan. So if you have like an offer letter from your employer, in some cases we are able to use that to qualify you for a home loan for a job that you haven't even started. But it's super important to have stable employment, a stable employment history for the past 2 years. And working full-time also makes the process a little bit easier. In terms of income, having your income documents readily available, you'll need at least one pay stub, sometimes up to a month of your pay stubs. We'll typically need a year or two of your W-2s or 1099s if you're a 1099 employee. And in some cases, we'll also need a year or two of your federal tax returns. There are more documentation requirements for different kinds of income, like 1099 employees, self-employed income, things like that. Be prepared if you are in those lines of work or if you do work for yourself to have a little bit more documentation required for your loan process. But it's really important too when you're anticipating that you're going to apply for a home loan to kind of get all of those documents ready. Number three would be concerning your debt to income ratio. This is a ratio that determines whether or not you're approved for the loan and how much you can be approved for. It is calculated based on your gross monthly income that you earn each month versus your monthly payments and your monthly debts. The new mortgage payment is also factored into that calculation. For example, a conventional loan, we can go up to 50% debt to income ratio. So your monthly debts plus your new mortgage payment cannot exceed 50% of your gross monthly income. If your income is lower at the time being and you do have more debt at that same time, you might not be qualified for a mortgage until you pay some of that debt off or start receiving more income. Different loan programs also require lower debt to income ratio. So for instance, like with a USDA loan, we can only go up to 41% debt to income ratio. So that's quite a bit of a difference from conventional's 50%. Number four is sufficient down payment. Depending on your loan program and what you're qualified for, you might have to have a down payment for your loan. Down payment is not required for every single loan program, but it is required for about half of them. A common myth though is that you have to have 20% down payment. That is typically not true in most instances. Having a higher down payment can positively impact your mortgage application, but it is not required in most cases. It's important to note too that your down payment should already be in asset accounts. Typically with most loan programs, we do have to document any large deposits into your accounts where we see your 2 months bank statements that are required for the loan. We do have to document any larger deposits. It's important that your down payment is already in those accounts. It's not just recently deposited. It's not saved up as cash at your house because we cannot track cash. We can't use that as a source of down payment. It's important to have those funds in your account ready to go. Number five would be concerning emergency funds or possibly reserves. This isn't required in all loan programs. Every loan is different, and with certain loan scenarios, you might require reserves on your loan. So this just means that you have reserve funds on top of what you would need for your closing costs and your down payment. So certain loan programs might require 1 to 2 months reserves. Certain investment property purchases might require more reserves. So just having a little bit of cushion in your account does help for certain situations. Number six, a clean credit history. So as part of the loan application process, we do pull a tri-merge credit report. This means that the credit report, it does cover all 3 bureaus, so Experian, TransUnion, and Equifax, and we will look at all of your credit history that is appearing on your credit report. This includes any bankruptcies or collections you might have. It also includes your credit inquiries, so anyone who has pulled your credit within the last 120 days. And it also goes through all of the accounts that you've had open. It'll go through the balances that you have on those accounts, your minimum monthly payments on accounts, and it'll also show us if you have any late payments. It's important to know if there are any errors in your credit report and to get those fixed prior to applying for a mortgage, and to note that any derogatory items listed on your credit report could impact your loan approval. So things like collections, charged off accounts, late payments, certain things like that could potentially impact your loan approval. Attempt to make on-time payments for a while before applying for a home loan. And number 9, which we've already touched on a little bit, is documentation preparedness. You are going to get a list from your loan officer as soon as you apply for a home loan of documents that you will need for processing and underwriting of your loan. Typically, these are not required upfront, they're just required during the underwriting process, but it is helpful for your loan officer to have them ahead of time to be able to confirm that what you've submitted on your application is accurate based on what your documentation shows. This list that I would probably recommend to kind of gather up, save, get on your computer, print it out, get ready the last 2 years of your tax returns and any corresponding W-2s or 1099s, most recent 2 months of your bank statements, your most recent month of your pay stubs, non-expired driver's license or photo ID. That is kind of the bare minimum of what your loan officer would typically need. In some other cases, we might need additional paperwork. For instance, like if you're getting a VA loan, we would need your discharge paperwork. If you've been married or have child support on your loan application, we might need your divorce decree or parenting plan, things like that. Documentation will change person to person and just kind of be dependent upon your financial situation. Solidifying these aspects to prepare for applying for a mortgage, it's really going to put you in a better spot once you do get to that point. All of these things would help you present a strong case for yourself and why your lender should loan you the money for a new home. If you have any questions though prior to the application process, please reach out to your lender. We can always talk you through the process before you ever hit the submit button on the application. We would love to answer any questions or ease any worries that you might have before you do submit that application. I am available pretty much 24/7 whenever I am awake. You can call me, text me, or email me, and I would love to help answer your questions.